Have you ever wondered how your 401k stacks up? Are you saving enough? Is your balance big enough? How does it compare to your peers by age group, by income, by length of job? Now, fortunately, Vanguard just released their latest study, and it delves into many of these topics. We can see the average 401k balance. We can see savings rates. We can see a lot of demographic data. We can see information about employers match. We can even see what kind of returns others have been generating. The latest study is chock full of interesting info, which we're going to cover in this video. Now, my name is Scott Caufield. I'm a CPA, CFA charter holder, and the founder of Sophos Wealth Management. So Vanguard's latest study is called How America Saves 2025, and they're going to look at 401k data for nearly 5 million different participants. So we've got 4.8 million in their 2024 data, which came out in 2025. So the average participant is 43 years old. They've been in their job for 6 years, and we've got an average or median income of $89,000. How much are these participants saving, at least as a percentage of their salary? And what you're going to see in these 4 columns or 5 columns here, you've got 2020 through 2024. Median deferral rate, meaning the median percentage of income that people are saving, is just under 7% for 2024. So 6.8. And that has actually ticked up a little bit from, say, 2020, 2021, and 2022. So nice to see that a little bit higher, although, I do like to see it at 10% plus. You will see about 25% there are saving more than 10%. And you're going to see 45% are increasing their deferral rates each year, which is another good stat here. You're going to see the average total contribution rate. So this is going to be employee and employer combined. That's going to be 12%. The median here is 11.5%. So it is a little bit over 10% when you throw in the employer match. Now, let's break down to the real nitty gritty of how much people are saving with the demographic data. Some of this is not that surprising. So, if you look at the income data here, obviously higher income, 150,000 plus, going to save a little bit higher, 8.6. Interestingly, the $100,000 to $150,000 cohort is a little higher, 9.1% of their income saved. Low incomes, under 15,000 to 29,000. That's going to be some of the lower deferral rates, 5.9, 6.8, not super surprising there. Similarly, age, younger Americans are saving like 5.5% for those under 25. Older, 65 plus, as high as 10.1%. And these are again out of the 2024 numbers. Job tenure, the longer people have been there in their roles, the more they're saving. That's probably a positive, but not that surprising statistic. Used to be not a lot of people were automatically enrolled when they first started in their plans. That is less and less common now. And then account balance. So obviously the higher account balances, say $250,000 plus, have deferral rates of 11%, and the lowest account balances under 10,000 have the lowest deferral rates, only 4.1%. It is interesting. You can kind of see based on your age, how does your savings rate stack up? Based on your income, how does your savings rate stack up? Maybe give you something to shoot for, and at least let you know whether you're ahead of or behind your peers. Now, next question is, how big are 401k balances? So the median balance in 2024 is $38,176. The average balance is almost 150,000. So 148,153. And those are up pretty nicely from 2023. Not surprising given the strong stock market returns last year. Again, we can break this down into much more detailed data. So if you look at it by income level, once again, you're going to see bigger balances for higher compensated employees, lower balances for lower. So under 15,000, we got a median balance of just over $4,000. Those who are making 150 plus have a median balance of 220,000, and then an average balance of 377, almost 378,000. So not that surprising there, but nice to see and kind of get an idea of how your balance stacks up relative to your income. But then that's going to be heavily weighted by your job tenure. How long have you been there? You're going to see that at the bottom here. Not surprising, those who've been in their jobs under a year have the smallest balances. They've not been able to save. They've not been able to grow. Those who have been in their role 10 plus years, the median balance is 165. You're going to see those 55 plus tend to have the largest 401k balance. I suspect there's just a ton of overlap. We know those who are 55 plus have the highest incomes. They probably have longer job tenure, and they're going to be saving at high or higher rates. So, of course, they're going to have bigger 401k balances on average. It is worth noting when we think about these 401k balances, this does not represent somebody's entire life saving. It's going to mostly just represent what you've saved in this job, unless you've rolled a 401k from a previous employer over into this 401k plan. It's not going to show up here in this data. So just because it says the median balance might be 38,000, that doesn't mean the median person has 38 in retirement savings. They may also have IRAs, Roth IRAs, and savings outside of their 401k. So just want to make that note for you. Now, how much are employers contributing? Do you have a generous employer? Maybe a little bit of a frugal employer? So you're going to see 50% of plans have a matching contribution only, meaning if I give $1, my employer gives some percentage match on that. 10% have non-matching contribution only, meaning it doesn't matter what I give. They're going to give, say, 2% of my salary no matter what. Whether I give 0% or whether I give 20%, they're going to just put 2% in. And then 36% have both matching and non-matching components. So it might be a 2% flat, and then also maybe 1% up to, say, a max of, or dollar for dollar up to, say, 3% of salary or something like that. Only 4% of plans have no matching whatsoever. And as a percentage of participants, that's only 1%. So 99% of plans are going to give some form of employer matching, or at least some form of employer contribution. Be non-matching. Now on the right side, we're going to look at what are the most frequently used match formulas. So how are they actually matching you? Most common here is going to be 50% on the first 6% of pay. So if you contribute 6% of your salary, your employer will match half of it, or 3% of your salary, and that's the max. Now, next one, a little bit more generous than that, is going to be we give 100% on your first 3% of pay. So if you put 3% in, they're going to match 3%, and then 50% of the next 2%. So basically, they'll do a total of 4%. So if you put in 5%, you'll get a 4% match for an overall contribution of 9%. It gets a little better with the next one, the next most common. So they'll put 100% on the first 6% of pay, and then 100% on 5 and 4 are the next two most common. So just kind of interesting. I've heard of far more generous plans out there, but I've heard of more stingy as well. So you might just want to dig into the details of your plan, just kind of see how it stacks up. This chart right here from Vanguard is going to show you distribution of the maximum match from employers. So again, most employers are going to give you somewhere between 3% and 5% of your salary. That is most common. You're going to see obviously the majority of plans as well as the majority of participants. That's what they're going to get. Not that many are less than 3%. Kind of unfortunate if you're under 3% on what you're getting on a match. But you do hear stories of some employers matching up to 7, matching up to 10. Really nice, really helps you compound your retirement savings if you can find it. Next thing that I think is pretty interesting is what kind of returns are people getting on their 401ks? I was actually delightfully surprised at how high the returns are. I have seen studies before showing what the average investor has earned in equities, or at least earned in their investment accounts. And they're often anywhere from 1% less than, say, just a blended portfolio or from a pure equity portfolio, to as much as like 4 or 5% lower on an annual basis. So I've seen them drastically lower in other studies from other sources. This one's showing they are earning quite close to the market return. If you look at the top part of this page, you're going to see the average one-year participant return. So we've got 2020 was around 15.1% was the total return, 14.6% in 21, loss of 15.8% in 22, gain of 18.1 in 23, and a gain of 13.7 in 24. So that is actually tracked pretty closely to a 60-40 portfolio. That's actually not bad performance out of the average 401k participant. I frankly expected it to be lower when I first looked at it. So that's good that people are mostly picking an allocation and sticking to it. If you look down below, you can kind of see what people's allocations to equities have been. So you're seeing they've gotten a little bit higher. We've gone up from about 72% to 75%. So allocations, both in terms of existing balance as well as the contributions to equities, are getting a little bit more aggressive. It does make me nervous given how expensive I think the US market is today. But it's still worth looking at and seeing how yours stacks up. Always want to keep in mind, though, your personal risk tolerance, goals, all that kind of good stuff. Now, a big driver of the increased exposure to equities, you can see in this chart that they provided. So back in 2015, something like just over a quarter of plan participants were in target date funds. As of 2024, that's up to 42%. And then another 41% have just kind of picked a diverse blend of funds, which are really seeing go away. Far fewer people are allocating to cash, which is probably not that bad of a thing. You're also just seeing a little bit less into company stock, a little bit less into other balanced funds. So for a lot of people, the target date funds are just an easy set it and forget it way. However, I do wonder, is an ever increasing exposure to equities necessarily the right move for everybody? Yeah, it's questionable. All right, some of the other just miscellaneous data, they showed that something like 18% in 2024 were using a Roth in their 401k. Roth 401ks are great options if you expect your future tax rates to be higher than your current tax rate. So a lot of young employees, that's a great option for. You're also seeing about 10%, that's held steady, that are using after tax if offered. I hope that everybody doing after tax is doing it because they are doing a mega backdoor Roth. So you do these after tax dollars, meaning you don't get any tax benefit to contributing to it, but then your plan allows you to roll those after tax dollars to a Roth using an in-plan conversion. I would hope all 10% are doing that. I suspect the majority are. Maybe it's a mistake for some people. The other thing that I don't love, you're seeing about 13% of plan participants taking out a 401k loan. I believe the average balance is somewhere around $11,000, the study said. 401k loans, my biggest gripe with them is often that it's just, one, you lose out the future compounding of that balance, and two, it's often just funding unsustainable spending. It's not truly a one-off. It's going to quickly be repaid. So just like a little note of warning there. Not my favorite, unless it really is just a one-off emergency. You can kind of quickly refund or pay back. You're also seeing hardship withdrawals on the rise. Participants who used a hardship withdrawal was 1.7% in 2020. That is up to 4.8% in 2024. Kind of a worrying trend, and kind of fits with the idea that people have talked about, kind of this vibe session, or there's a certain percentage of the economy that's just having a hard time keeping up. And that would probably be indicative of that, the fact that 4.8% have taken a hardship withdrawal. So, in general, I think this is a great study, provides a lot of interesting information. I encourage you to check it out yourself if you're kind of a nerd like me and you want to get into the weeds of all of it. Appreciate you tuning into this video. Like it, subscribe to my channel, and share with anyone you think would benefit. Thanks a lot.